30 minutes till the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, an $80 billion gamble. Alphabet lines up massive funding for AI spending.
Anthropic's confidential IPO filing could give it an edge over OpenAI as the rivals race to go public.
And Ken Griffin's Citadel is launching a program that will pay for trading insights from other hedge funds.
I think the Alphabet story is incredibly consequential from this market. This goes from balance sheet spending to a capital market story, and we're competing for capital between this and IPOs right now.
Yeah, it's a story of dilution. $40 billion of at-the-market stock sales.
Yes.
And they will raise more money than SpaceX with this.
Yeah, and let's look at what it's doing pre-market because of that dilution, falling 3%. But again, I think this is an entire of the market story. Yeah, it hits Alphabet shares, but that money needs to come from somewhere. And if we're going to be spending money on $80 billion worth of Alphabet, huge IPOs coming to market. I know we're talking about Anthropic filing soon. Money's got to come from somewhere. There's more supply coming into this market.
But there's so much of it, right? I mean, the bond spread story, the hedge fund story, they have way too much capital. They can't even put it to work.
Could that change? Could that change at some point if we keep getting more of this?
I imagine it will at some point. Hewlett Packard Enterprise, HPE, is surging on much stronger demand for AI products than estimated. The stock had gained more than 60% in the past month before today's move. And you can see it's another 28%. I'm looking forward to Ed Ludlow's interview of the CEO on Bloomberg Tech a little bit later.
As am I. But first, let's dig into the equity sale with Bloomberg Intelligence senior analyst Anurag Rana. Anurag, I wonder what even the logic is for this, because these hyperscalers can easily go to the bond market. Bond market absorbs whatever they want. They can go to private capital. They're happy to put together deals with them. Why do something that ultimately sends shares lower and is dilutive for them?
Yeah, but it's only 3% lower, frankly. It's also the same thing Oracle is doing. It's basically told the bondholders, we don't want to mess up the credit rating, and we're going to do equity offering as well as a bond offering. So, these guys will look at cost of capital for them through multiple areas, and wherever they find the best deal, they'll go for it.
Yeah, and I mean, $40 billion. It sounds like a lot of money, but we're talking about a $4.5 trillion market cap. Are we going to see the other hyperscalers come to market this way and sell shares at the market price?
See, I do not know about selling shares or how they're going to lift in terms of how they're going to raise capital, but they have to go out and say, well, we have to match what Google is doing in terms of at least the sentiment. It may not be the same dollar amount of capex going up, but I'll be very surprised if either Amazon or Microsoft don't come out next month or whenever they report and say, well, we're going to raise capex too for next year, because at the end of the day, it's all driven by this boost of or the backlog growing for each of these cloud providers, and one of them just can't go out and say, well, I'm going to stop spending.
Is this something that we should think about beyond then Alphabet in that case and what you're saying, Anurag? Should investors, growth investors especially, start thinking about pricing in more equity dilution?
See, again, as I said, I can't comment about equity dilution because Microsoft so far hasn't even, I think, entered the bond market at this point. So Microsoft is just funding a lot of that by itself or signing leases with others. But again, financial flexibility aside, one thing is for sure at this point, that the need for compute remains very strong. And that's an area where, if you thought you needed X yesterday, after 4 o'clock yesterday, we thought, well, we need X plus, another 10% or another 20%. So that story is not, we are not seeing the tail end that we're going to see a decline in CapEx. So we're looking at 26 CapEx very strong, 27 most likely, much higher than 26.
Gracias, Anurag. Bloomberg Intelligence senior analyst Anurag Rana reporting there from right outside of Wrigleyville in Chicago. Hewlett Packard Enterprise is soaring pre-market after saying revenue for the fiscal year will increase by more than 10%, more than 10% more than Wall Street estimated. Let's bring in Bloomberg Tech's Ed Ludlow to help us set the record straight here. And by the way, you have a CEO interview coming up on Bloomberg Tech.
Yeah, so the question is, what is new in the outlook? If you raise your outlook, what literally accounts for the new part? Is it a single customer that came in and changed the balance of the year? Is it in aggregate something that's picked up in a specific sector? But what's kind of interesting about it is that for the sort of dual outlook, so full year 2026 revenue growth of about 31% when the street was looking just below 20%. And HPE went a step further and said, actually, for full year 2027, revenue growth will be about 10% when the street was seeing basically half that, with HPE making the argument like, if we give you this even further outlook, we're giving you evidence that this is durable, this is real. And so in this cycle of raising cash through equity markets or debt markets, capital expenditures, HPE puts the server together. And so you might see it as a leading indicator for what's actually happening in the real world, where that capital expenditure is being spent.
And I'm sure you also spent a lot of time on Bloomberg Tech today talking about the IPO race after Anthropic files confidentially leapfrogging OpenAI. Sam Altman did once say on CNBC, oh, it doesn't matter the timing. We'll IPO when it's right for us. Is that fair, Ed? Is this ultimately just a race of who gets to the market first, much as it is a race of who has the better models?
Yeah, I've been on the phone all night about this. And it also links to what's happening with Alphabet, right, in their equity raise. It is a first mover advantage to Anthropic, but not just first mover advantage to go public. There's nothing in the confidential S1. There is no price range, no volume offering. We don't have any terms disclosed. But there is a race now for what is a limited, finite pool of capital. There is not infinite liquidity out in the world. So SpaceX raising $75 billion, Anthropic maybe in the fall, OpenAI, we still are reporting that the confidential filing could come any time. And Alphabet going to market to raise $80 billion. There's an HSBC note this morning that says exactly that. It is a race and competition for capital at this point. There is a lot of interlink between Alphabet and Anthropic as a case study and example. Anthropic is spending $1 billion or more a month on SpaceX compute. They all need cash. Their fates are all closely tied. But that's like a really interesting way of looking at it.
I love that way of looking at it. These deals are all competing for the same institutional pools of capital. Ed, thank you very much. Bloomberg Tech co-host Ed Ludlow, and as Matt mentioned, he'll be sitting down with the HPE CEO Antonio Neri today at 11:40 a.m. New York time. And as Matt also mentioned, the pools of capital
are huge.
And they are looking for deals and ways to make more money. Among them, Ken Griffin's Citadel is prepping a program that would pay other hedge funds for their best ideas. Joining us now is Bloomberg's chief hedge fund correspondent, Nishant Kumar. Nishant, I think about strategies like this often on the sell side. You pull a bunch of sell side analysts, get their best ideas, maybe trade on it. What does it look like to do the same thing on the buy side?
Well, it's the same thing. Actually, sell side is the origin. 2.5 decades ago, Marshall Wace pioneered that process. It collected information from sell-side analysts and sliced and diced and removed all the noises and biases and tried to get signal out of it and then potentially trade on those ideas, or at least some of those ideas. It's no different than someone sitting at another hedge fund or asset manager or an analyst on those desks, providing with the same idea. So it's the same process, actually. So just the sell side is extending into the buy side for this process.
I love the last graph in your story where you point out, Nishant, that the hedge fund industry's big multi-strat firms like Millennium, Citadel, Point72, they have more capital than they have the capacity to deploy. Where is all this money coming from?
Well, all these multi-strats have record of producing steady returns for, a long period of time. And that's why investors are getting to them and investing more and more to them. So much that, most of these large hedge funds have stopped actively raising money. And some, including Citadel, have even returned like billions of dollars in the recent year. And that's why this alpha capture makes sense. Because they have so much money, if they want to manage more money, they want to look for newer ways to deploy that capital. Some hedge funds are doing it by allocating a part of money to external traders. Some are using alpha capture model so that they get more data, more intelligence, and potentially they can turn some of those signals and intelligence into trading signals and ideas that they can trade on.
All right, Nishant, great story. Recommend everyone check it out on the Bloomberg terminal or Bloomberg.com. Bloomberg's Nishant Kumar covers hedge funds for us out of London. Now, quick check at what's going on in the markets. We're looking at red arrows here. S&P futures down 0.3%, but we did see the cash close yesterday at near as damn it to 7,600. I think it was 75.99.9. And you can see NASDAQ futures are also down about 0.25% here. Treasury yields are coming down, so 443, 444 on the 10-year, and oil is coming down as well, although Brent's only off 15 cents. It's trading at 94.78. Let's get a look at some of the single stock stories we're following for you today. Dollar General raised its earnings outlook as shoppers look for discounts, and this is one Meredith Whitney flagged to us yesterday.
Indeed, yeah. I mean, it does show that there is strength. This is certainly not an uptrend consumer shopping here, shopping there. A similar type of strength coming through for the consumer. Victoria's Secret is surging on an earnings beat and a raise as the CEO Hillary Super's turnaround plan gains momentum. Citrini made a great point. Setting fashion trends, the people who are spending are women between 18 to 24, and portfolio managers are decidedly not young women aged 18 to 24. So it was like a big missed opportunity for this market.
But the insane thing is that this stock is already up 160% in the past 12 months. So this goes on top of that.
And it also had a lot of short interest in it, a lot of short sellers because of that big gain, so getting punished today.
I saw that S3 data. All right, Marvell is surging after NVIDIA CEO Jensen Huang merely suggested it should be worth more. He said it's the next trillion-dollar company. That's would be more than a fourfold increase for the company, and it's headed that direction today with a 16% gain.
All right, its market cap just about $200 billion. So yeah, has some ways to go.
Coming up, President Trump has just named Bill Pulte as acting director of national intelligence. More on how and why from Washington, D.C. next. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Short seller Andrew Left, the founder of Citron Research, was convicted of securities fraud after prosecutors accused him of misleading social media posts to move stocks and profit from rapid trades. A Los Angeles jury found him guilty on 13 counts. Left denies wrongdoing. He plans to appeal and faces sentencing on August 31st. President Trump says the U.S. could reach an interim deal with Iran within days. He said that again. Despite tensions sparked by Israel's expanding military campaign in Lebanon, Iran wants a Lebanon ceasefire included in any agreement, while disputes remain over shipping routes, frozen assets, and Tehran's uranium stockpile. And President Trump has just announced he is tapping Bill Pulte, the head of the Federal Housing Finance Agency, as the acting director of national intelligence. Trump posted on social media Tuesday that Pulte would also remain in his role as FHFA director. And as chairman of Fannie Mae and Freddie Mac, Tulsi Gabbard has announced that she would step down from her role as director of national intelligence just this month. Let's get to Bloomberg Washington correspondent Tyler Kendall. Tyler, so what do we know about Bill Pulte's experience in the intelligence industry? What does he bring to the table for President Trump?
Well, Matt, at this point, there's a lot of big questions here about exactly why President Trump made this announcement and why at this moment, though, of course, it does follow, as you mentioned, Tulsi Gabbard giving her resignation in for DNI. President Trump saying that Bill Pulte will remain as the head of the FHFA. But keep in mind that an acting position means that he doesn't need to be Senate confirmed. So perhaps it's unclear if we'll get total answers around what his experience in this particular area does look like. Pulte is, of course, a very staunch ally of this White House. We have become very familiar with him because he has led some of the administration's staunchest criticism when it comes to the Federal Reserve, and also led that probe that we are still waiting to see resolved when it comes to alleged allegations of mortgage fraud by Fed Governor Lisa Cook. Bloomberg News had reported back in November that Bill Pulte was originally passed over over for some top posts at the Department of Housing and Urban Development before ultimately being tapped for this FHFA position that he currently leads. But President Trump, in this post on Truth Social, really applauding Bill Pulte, calling him this loyal ally, and saying in part, quote, that he has been managing the most sensitive matters in America, the safety and soundness of the markets, and over $10 trillion at Fannie Mae and Freddie Mac. So we'll see how this dovetails into the president's national security priorities, because, of course, there is now this hole with Tulsi Gabbard leaving the administration.
Tyler, it also raises important questions, given we are in the middle of a war right now, and one that seems, again, to ever be on a knife's edge, with the president saying recently, I think you're talking about over the next week in terms of reaching a deal, but at the same time, what's happening with Israel and Lebanon? Because this had been the sticking point and why Iran reportedly has stopped talking to the United States. The president says that they will be reaching some sort of agreement, or they'll stop shooting at each other, I think was his exact words. Have we heard from the Israelis on whether that's the case?
Well, we seemed to have gotten a different tone from Israeli Prime Minister Benjamin Netanyahu after what was reportedly a very tense call with President Trump yesterday. Netanyahu did confirm that Israel has plans to pull back from a planned attack near Beirut, but that ultimately the Israeli operation in southern Lebanon would continue. Now, we should, of course, say that Israel isn't a party to the U.S.-Iran negotiations, but Iran at this point has long maintained that a ceasefire in Lebanon is going to be required for any sort of deal. And it really did show up as the sticking point here, as we saw President Trump had to pursue the diplomacy himself, getting on the phone directly with the Israeli prime minister, as well as with representatives of Hezbollah. At this point, the White House says that it has made progress, that it has appeared to got over this apparent roadblock. President Trump said that negotiations are continuing at a, quote, rapid pace. And we can say that Iranian state media did report overnight that negotiators are looking at the, quote, final text that they want to supply the U.S. to review. But Matt and Dani, at this point, we also heard from Iranian state media saying that there is still this very high risk that we could ultimately see the talks collapse.
We did see just a couple of hours ago headlines from the IDF saying that Israeli forces were likely to go into southern Lebanon, reminding residents of a city there to evacuate. I want to know about an issue much closer to home. President Trump's $1.8 billion weaponization fund. It may be put on hold. At least that's the signal we're getting from the administration, as I understand it. But do we know about the immunity that he's given himself from future IRS probes and maybe even from any future litigation from the federal government?
That right now is the biggest question, Matt, because we did get this signal yesterday from the Justice Department that they would temporarily halt this planned weaponization fund. So that means it's going to be put on hold for now. But then there's conflicting reporting. Some sources are saying that the fund is completely scrapped. Others are saying that this is just a halt. But the biggest question remains how this impacts one of those provisions in that settlement between President Trump and the IRS, which established this fund on one hand, but then also, as you're mentioning, established that President Trump and his family members wouldn't be subject to probes in the future. It's not just Democrats, though, who have raised these questions. We really saw yesterday Republicans put up demands that they want more clarity on exactly whether or not this fund is going to go away. And they do have the power to make those demands, because currently it's Republicans who are holding up this planned reconciliation vote to get more money for some of President Trump's top priorities related to immigration and law enforcement. We were actually live on the air last week on Balance of Power when Republicans had said that they weren't going to move forward with those priorities over concerns with this weaponization fund, what sort of guardrails could be put on it. But now it appears that the party is coalescing around this idea that they want the fund to be done with altogether and completely. So definitely need some more clarity here, including from Senate Republicans who are demanding that they need to see some firmer commitments from the administration on exactly what this is going to look like in the future.
Tyler, thank you very much for that. That's Bloomberg's Tyler Kendall, again, on breaking news coming out in just the past few moments that President Trump has tapped Bill Pulte, the current head of the Federal Housing Finance Agency, as the director of national intelligence, a man who does have no experience in military or intelligence, but is quite loyal to the president. Coming up, why RaeAnn Mitrione from Callan Family Office says the S&P 500 may be undervalued as it hits another all-time high. This is Bloomberg Open Interest. Earnings have been so stellar this quarter that the S&P 500 is actually trading at a bargain compared to the start of the year. RaeAnn Mitrione from the Callan Family Office says valuations are elevated, but this has been an earnings-driven market. On a forward PE basis, the S&P 500 is actually trading at a slightly lower valuation than where it started the year because earnings projections have grown significantly. Let's bring in RaeAnn herself, the Callan Family Office market strategist and founding partner. So how much further does it have to go then? Because we've already seen record after record really driven by strong earnings.
Good morning, Dani. We've certainly seen a lot of momentum, especially since the March lows. And a lot of that really has been supported by the strength in earnings that we saw in the first quarter. We came into earnings season with an expectation of earnings growth of 13%. And that really ended up around 29%. So that's a really big difference. And all along the way, we've also seen estimates moving up for the rest of 2026 and into 2027 on where those projections for earnings are. So even though we've seen stock prices move up, the earnings are moving up, basically in tandem. So we haven't seen valuations get that stretched as a result of this move.
Yeah, the forward 12-month price earnings ratio for the S&P is less than 22 right now. Does that continue, you think, even as we raise the P?
I think that can continue. We've seen, we're having record productivity and profit margins. And if that continues, obviously, that's good for earnings. That's good for the broader economy. Yep. And that'll continue to support stock prices. It's not that there are no risks out there, but there's certainly a lot of support of why this can continue.
All right, you know what, RaeAnn, we're going to take a quick break, come back with the opening bell, and then more with RaeAnn Mitrione after this. Moments right from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Let's check quickly on futures after hitting 75.99 in the cash trade yesterday. You can see S&P futures are off about 0.2%, even as yields come in and oil drops, although it's very slight, that drop in crude. NASDAQ futures really unchanged now. At the New York Stock Exchange, Dime Commercial Bank ringing the opening bell. Over the past 5 years, the shares are up 7%. But if you've reinvested your dividends, it's a 28% gain. Maybe you would have been better off with the index. Xenon Pharmaceutical ringing the opening bell down at the NASDAQ. They're celebrating some success in epilepsy drug trials, and their shares over the past 5 years are up 185%.
Okay.
So that's why they're so happy. Plus, it's a bucket list thing, right? You get to ring the opening bell. You get to start trading in America.
It looks like they maybe, they look very happy. Good for them. Very happy.
This guy has a Band-Aid on his head.
I thought it was confetti for a moment, but I think it is a Band-Aid. I don't think they drop confetti at an opening bell, do they? They should.
I think it is confetti.
Oh, really? They do confetti?
Yeah.
Oh, that's cool. I did not realize that. Anyway, Matt, at the Open, I'm watching Alphabet after announced plans to raise $80 billion to help fund its vast spending on the AI. A lot of that is going to come through equity offerings. And again, this is so consequential because this is no longer just a balance sheet story. This is no longer just spending on debt. It is a dilutive event. Not just for Alphabet, but for the entirety of this market. There's a lot of the same institutional pools of capital competing for not just Alphabet shares, but the mega IPOs. Yes, Matt, there's a lot of money chasing things, but what happens when that supply starts to catch up? I think it's not just a dilutive event. It's just so cool to see SpaceX say, we're going to raise $75 billion, and then Google says, hold my beer for a second. Yeah, we could do that in our sleep. We don't need it. We don't even need to IPO, you know?
Hewlett Packard Enterprise is surging on much stronger demand for AI products than estimated. The stock had gained more than 60% in the past month before today's move. Now it gets ratcheted up another 35% in the cash trade, 63.49 the level. Let's bring back Callan family office market strategist and founding partner RaeAnn Mitrione. And RaeAnn, you know, everywhere you look, there's just mountains, I mean, not in my bank account, but everywhere in markets, mountains of cash, right? Keeping spreads super tight. Hedge funds have so much capital, they don't have the ability to deploy it all. Google can just snap its fingers and raise $80 billion. Where is this coming from, and what happens if it gets reversed?
That's a great question. And certainly when you see this much momentum moving up and supporting in one direction, if anything were to change, it can move hard in the opposite direction. It creates some fragility. But there is no shortage of interest in investing in all things AI related. And we do think we're still in early stages of this. So while we're seeing this incredible CapEx that's been happening, you know, 500 billion last year, or north of 700 billion this year, potentially over $1 trillion next year. And everyone wants to be a part of that story and invest in any way they can. So even though we're seeing these incredible capital raises, there does seem to be the demand to support it right now.
I still was talking to someone and just looking at private markets, which I know you also participate in at Callan Family Office. The insurers have been a large pool of that capital that's been going towards a lot of the AI infrastructure build out. But someone made the point to me that if you look at what plans are going forward and the intense need, there literally isn't enough capital to fund the necessity that we need for AI infrastructure. You combine that with all the debt that's being offered, be it 100-year notes from various hyperscalers that's easily being swallowed. You add in the mega IPOs from SpaceX to Anthropic to OpenAI, RaeAnn. Is there a big risk that supply starts to catch up with demand?
There is a risk because everyone is in this area, but the demand is extraordinary. And like I said, I really do think we're still in the early innings of this. And there is going to be explosive demand as companies really start to figure out more broadly how to use this, how to integrate it. And the demand is going to be extraordinary, really, across industries, across companies, across the world. So for now, it does seem like it makes sense that everyone is doing all this spending and raising capital to be competitive in this environment, because there will be significant returns on this over time.
Is there any place you think, RaeAnn, that the market hasn't yet identified a bottleneck? We've moved from, first these large language models to the chips, obviously, and then the power, and now we're looking at like HVAC guys who are going to help build these data centers. Like, what's the next thing that this market's going to bid up?
That's a great question. I mean, we certainly have seen that there's this seemingly unending demand for chips, and it's certainly spilled over into industrials and into the power generation sector. It's hard to say where the next winners will be that will benefit from this, but really anything that's going into building out these data centers and continuing to deploy on this AI, anything can happen in this space.
In the meantime, perhaps in the consumer, real economy, whatever you want to call it, those earnings look really strong too, RaeAnn. I mean, just today we had one of the dollar stores reporting very strong earnings, Dollar General, which, is not a high-income consumer. Victoria's Secret also posting extremely strong earnings. Does that lead to its own sort of problem, though, that perhaps the consumer is not as weak as we thought, and some of the inflation is demand-led, not just supply?
There is some of that. It's a little bit on both, right? We've seen inflation tick back up somewhat as a result of oil prices and the spillover from there, but consumer spending has remained strong. And some of that was supported most recently by the tax refunds that were elevated, and we'll see if that continues. But so far, there's not much to support that there's any significant weakness coming from the consumer. And that really is great, because consumer spending makes up 70% of our economy. So we want to make sure that that's continuing, but obviously not to the level where inflation continues to move up in a concerning way, because that obviously leads to other issues.
I mean, we heard from Beth Hammack today saying this inflation number may not, at 3.8%, may not get down to 2 if they don't help with some policy, which is like, okay, that's what they're supposed to do. But do you see the Fed raising rates? Is that potentially going to turn the inflation problem around, or just gum up the economy?
It's a question mark. I mean, we came into this year talking about rate cuts, and now that's basically entirely priced out, and we're looking at basically 50-50 odds of whether we'll see a rate hike by the end of the year. And right now, the Fed has the luxury of really waiting and seeing what direction this goes in, if we see inflation continue to trend up or start to stabilize, because we have had a lot of stability as it relates to the labor market and the economy broadly. So they're able to kind of pause and see where we go from here and what the data shows. But it's possible, if it continues, that we do see a rate hike at some point in the future.
RaeAnn, thank you very much for joining us this morning. That is Callan Family Office market strategist and founding partner RaeAnn Mitrione. Let's now get a check on your equity markets about 8 minutes into your trading day. And we fall from highs after reaching 5 consecutive highs for an 8 straight day rally, the first time we've done that so far this year. We're only down about 0.1%. Again, is it because of a dilutive event of Alphabet, of all the need of capital going into various places in this market? Leading us this morning, some of the AI plays, Broadcom, NVIDIA, those go to the top of the pile. We've been hearing from Jensen Huang at that event in Taipei. And we're also seeing Hewlett Packard, really strong earnings too. To the downside this morning, it's Microsoft, Alphabet, Amazon, Intel, Palantir. So a lot of the mega cap names dragging us lower. Again, Alphabet with that big equity raise. Looking at the sectors, communications are down. I showed you what Amazon was doing, so that's part of the reason that we're down. Consumer discretionary falls, even though we've had some good earnings from the like of Victoria's Secret. At the top of the pile, you see utilities, industrials, and energy, Matt.
All right, coming up, Google falls just slightly after an $80 billion equity offering. We talk about that and Anthropic with an analyst from Jefferies. Brent Thill joins us next. This is Bloomberg Open Interest.
Heading for your first down day in 8 after 5 consecutive records for a total of 23 record highs so far this year. The S&P down just about 0.2%, a third for the NASDAQ 100. Let's get you some top calls, the analyst action that we are following this morning. First up, Goldman downgrades Intuit to a sell, saying fundamentals may be worsening as competition heats up in tax software. Shares take another leg lower this morning, down 8.5%. Next up, Arete is upgrading Meta. They cite the company's flexible cost structure, growing subscription opportunities, and progress in AI development. Shares down 0.5%. Finally, analysts weighing in on HPE after the company beat expectations, sharply raising guidance. Morgan Stanley points to strong server demand. KeyBank highlights better than expected cloud and AI results. Those shares up 24%, Matt.
All right, so some big moves in today's market to the upside for the most part, but Alphabet is going the other way. The Google parent raising $80 billion through a package of equity offerings to fund its AI plans. Shares, as you can see, are down 4 2/3% as the company takes advantage of the recent stock market rally and growing interest in its homegrown chips business. Let's discuss with Jefferies equity research analyst Brent Thill. He has a buy rating on Alphabet. And Brent, what do you make of this latest raise? I mean, I thought $75 billion was a stretch for SpaceX, but this seems like a pretty easy move from Google.
Yeah, I mean, we're going to spend $1.2 trillion as an industry next year on AI build-out. So 80 billion is kind of a rounding error. When you think about it, these numbers are huge. But Google is in such a great spot, and they're leading this charge with an integrated stack of their own frontier model, their hardware, the semi infrastructure, and they have more data than anyone in the world, which you need for AI. So when you go back to ultimately what's happening and why they're doing this, they are in such a leadership position with Gemini, and you have OpenAI and Anthropic confidentially filed to go public. It is literally 3 vendors at the top of the leaderboard if this is a PGA tournament. And these guys right now are Scotty Scheffler. They are so far ahead of everyone else. I think what they're saying is, look, we need to get ahead of this, and we need to get ahead of what is about to happen, especially with SpaceX, Anthropic, OpenAI about to go public. I think it's a good move. I think it's a move that they're trying to get in front of what is about to hit and ultimately get the right funding. And I think that our due diligence suggests they're in a great fundamental position. They're not doing this from a position of weakness. They're doing this from a position of massive strength. And just recently, they've launched a new solution called Google Anti-Gravity, which lets developers build applications really fast. And this is the potential to have a breakout hit. So they just, they have a collection of things going really well. And I think ultimately, get in front of what is about to hit. And we know we're going to go from $700 billion to $1.2 trillion to spend. The AI investment cycle is still really early. We're not in a bubble yet because we haven't been able to fully roll out these data centers and get the services up. And so I think, again, it's a good move tactically for them to make this transition.
Brent, can I just clarify then? Is it a race for capital? For example, if Alphabet tried to do this after we got these mega IPOs, would they struggle to get that fundraising done, to get the equity sale done?
Perhaps. I mean, I think ultimately a lot of our clients are asking, what do I sell to get ready for SpaceX, Anthropic, and OpenAI? I mean, we're talking about a lot, when you think about the proposed size of these transactions, I mean, it's trillions. So ultimately, what do I bring down to make room for? And so I think there's going to be a transition. So, my independent advice is if anyone was looking at the public markets right now, you'd want to do it now ahead of this, or just wait, because there are, 3 giant wake turbulences that are about to go through the air. And so, clear it, get it done now versus what's happening. I think Google could come to the market anytime, honestly, given their strength and their size, their cash flow. I mean, remember, they have 126 billion in cash. They've got massive cash flow. So I don't think that this is an immediate need, and they're in a they've got a bad balance sheet. That's not what's happening.
Brent, on the one hand, these PE ratios are not shocking, right? I mean, wherever you look, you see the E rising, so that the P can barely catch up with it. Google is trading at only 28 times forward earnings, which isn't a crazy .com number. On the other hand, there's just, it seems like a sea of cash going into every asset in these markets, whether it's fixed income or equities or hedge funds, private assets. Like, there's so much money. Where is that all coming from?
There's a lot of money that's going into this, and I think it's being funded by a whole group of companies. Everyone thinks it's super narrow, but it's actually a pretty widespread group of capital. Ultimately, I think that the question is this capital going to pay off in an ROI? And I think it's too early to make the call long term, but tactically, we're seeing a big ROI on this investment. The capital is freely available, and I think, again, we've seen this across the board. When the CEO of SoftBank says this is 50 times larger than the internet, this, in my opinion, will create capital from globally to chase this. Remember, every board globally is talking about AI. This isn't a bunch of Silicon Valley companies here in San Francisco talking about AI. These are global companies, boardrooms, and they never ever talked about Bitcoin, Web3, client server to cloud. They never talked about any of the other tectonic shifts ever in the boardroom, okay? Every board's talking about this globally. So the money's coming globally, and it's coming from every industry, from healthcare to aviation to financial services. And I think the pushback now is, okay, well, we're gonna spend 1.2 trillion in the next into next year on CapEx. Where's the ROI? And you're going to have to wait for that ROI.
One aspect of the ROI, because there's been recent stories. There's one from Axios last week that an unnamed company accidentally spent half of $1 billion in a single month on, I guess, oops, token maxing. I didn't set any limits on Claude and how much my employees could use. Apparently, Mythos, according to the information, is incredibly expensive too. For now, Anthropic, the other LLMs, are subsidizing a lot of it. Once that stops, are we going to see a lot of business models really pressured in just how expensive it is to run these models?
Yeah, I mean, I think, our spend went from a few thousand to hundreds of thousands. So, when you look at, I think we're all going through this, but ultimately what's happening is if you get the ROI, you're taking money out of your IT budget in other places like services. Remember, services is a $2 trillion industry. You think about employees, every company in tech is slowing their headcount, if not reducing their headcount. So ultimately, this is coming out of human capital. At some point, and this will slow job growth and potentially cut it. And we're starting to see signals of this. It's not I don't think it's as severe as what the CEOs of OpenAI and Anthropic have said, but I think we're seeing the money coming from other places other than just the IT budget. Some have been incremental dollars given to by the board from other areas. Some I think we're going to see in other areas, and ultimately I think we are going to see a job slowdown and potentially cuts happening, and those jobs will be repurposed somewhere else. So that's happening right now.
So do you think that, well, okay, we don't have time to go into it, but if we do see a job slowdown and cuts, it'll be interesting to see how the Fed reacts to that. Maybe that's not really the ball of wax we want to unwind here. Brent, Thill, thank you so much for joining us from Jefferies. Hope we can catch up with you again soon. Coming up, SpaceX is working to pay lower banking fees than usual for its IPO, which is like, duh. If you're going to raise the most money ever in an IPO, obviously your fees are going to be way lower. That's next anyway. This is Bloomberg Open Interest.
SpaceX is negotiating to pay minimal fees to Wall Street handling its IPO, but banks are still likely to rake in about $500 million from the debut. Bloomberg Chief Wall Street correspondent Sri Natarajan joins us for more. Sri, I'd imagine that the power is with SpaceX here, because everyone wants to be part of this IPO, that they could probably throw their weight around.
Look, everyone in the finance operation at SpaceX is very much like Matt Miller. They're going to the banks and saying, if you're going to help us raise $75 billion, do not expect your usual fee. But the interesting part here is, on a typical IPO, and when we say typical IPO, think less than $1 billion, which is what you'd raise in a normal, regular IPO. Banks charge between 4 to 7%. And that fee does go down pretty sharply for the mega IPOs. But even in those cases, and if you think about some of the biggest ones in the last decade, the Facebook, Uber, Alibabas of the world, it would still be a little over 1%. So if SpaceX comes in at under 75 basis points or under 0.75%, that will be one of the lowest IPO fees on record. And it's also an interesting point because the last time we even hit that mark, or at least we can think of a big occasion, was the General Motors IPO back in 2010. And that was a whole different scenario because at that time, Wall Street was negotiating with the US government, which was the majority owner of the automaker back then.
This will still be the most money anyone's ever raised in terms of fees from an IPO, right? Even if it's only a fraction of a percent.
And that's the important point here, that even if it comes in at 0.6 or 0.7%, you're talking about a fee payday that comes in at roughly $500 million. Yes, split among 23 banks, where you expect the lead left, the Goldman Sachs and the Morgan Stanleys, to have the biggest chunk of that fee pool. This is an extraordinary fee event for the bank. But the one note of caution is, as we think about the rest of the year and as investors, analysts try and factor in what will this mean for bank earnings and bank results, and you think about OpenAI and Anthropic, you may want to consider what you may have previously thought was going to be $1 billion, $1.5 billion payday is not going to turn out that way, and you should expect some sort of a discount when OpenAI and Anthropic hit the market as well. So that's just something that investors have to factor in, because when we heard the news that Goldman and Morgan Stanley were leading the SpaceX IPO, you should take a look at the stock and the reaction there at that time. And those stocks both were up, I think, 5 or 6% on the day because there was a lot of enthusiasm behind that. So this maybe tempers that enthusiasm ever so slightly, right, but there is no taking away from the fact that this is an extraordinary event for the banks, and this will be an extraordinary year for them if these IPOs go smoothly.
Sri, thank you very much. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. We struggled to hold on to gains after 8 consecutive days, and that would be 5 consecutive record highs, 23 for the entirety of the year. A strong equity market may be somewhat diluted by all the equity offerings coming from Alphabet and more IPOs to come. But again, little changed on this market, and I know in just moments we're looking for JOLTS data.
Yeah, I mean, we're still at 75.90
it's incredible.
plus on the S&P 500. We closed, I like to use the British term, near as damn it. I don't know if that's acceptable.
I think it is.
But 7,600 yesterday on the S&P. It's pretty wacky. And yet, the earnings continue to keep up. We have breaking economic news, as Dani mentioned. We get the JOLTS data right now. So 7.6 million job openings, far more than had been anticipated. The rate strong, 4.6%. The quits are a little bit less than had been anticipated at 2.977 million, so 3 million quits. The quits rate a little under 2% at 1.9. Layoffs weaker than expected, 1.692 million. The layoffs rate 1.1%, pretty low. Helping us to break down this jobs data, reaction to it, is Bloomberg economist Stuart Paul. So this is really good data.
It is really good data. Look, the consensus was expecting a small decline. We expected just an 85,000 uptick in total vacancies, and we get instead 730,000 uptick. But I want to dive in just a little bit deeper because almost all of that is concentrated in professional and business services. There's also a pretty significant increase in some of the more secularly driven industries like healthcare and social assistance, downstream of demographics. Also pretty notable that there's a decline in accommodation and food services, one of the items that's most cyclically sensitive. So where you see a lot of the increase is healthcare and social assistance, which is very much so just downstream of demographics. It's all just it's mostly just a structural issue. Where there's any sort of cyclical sensitivity, something like leisure and hospitality, we're seeing a little bit of weakness. And just to zoom out and factor in this month's major number, professional and business services, we're supposed to be seeing a lot of crowding out of jobs from AI. We're supposed to see a lot of the professional and business services jobs AI'd away. Instead, we're seeing some additional labor demand, I guess, as firms reassess how much labor they actually need as they start incorporating AI tools into their business.
That is a really interesting point, and maybe helps to alleviate some of the worst of fears. We'll see how long that lasts. But that's the fact that it's a very concentrated jobs gain in things like healthcare. I mean, that's really been a factor of this jobs market for the past year and some change, hasn't it?
It totally has been. This is not a job market where you could say there's a lot of labor market dynamism. We see that again this month at the quits rate. If we see a lot of labor market dynamism, if workers have a lot of opportunities out there,
they quit.
They start quitting. Instead, we're seeing a decline in the quits rate. So if we're seeing a decline in the quits rate, if we're seeing concentrated vacancies, if we're seeing concentrated hiring, it does not speak to broad-based wage growth here. As much as I like to get favorable economic data like a 730,000 increase in total vacancies, it's not broad-based enough. There isn't enough breadth throughout the labor market to suggest that wage growth, and so aggregate labor income growth and personal income growth, are going to be rising. Instead, over the first 4 months of this year, we've seen nominal aggregate labor income growth running at an annualized pace of just about 3.5%. Workers' income growth, while about consistent with 2% inflation, is being swamped by the supply shock induced inflation that we're getting from both tariffs, chip shortages, and the global energy shock.
So just to be clear, right, we're talking about job openings here.
Yes.
It's not that they're adding jobs. This
Correct.
economy is needing people to fill jobs that they don't have. And I'm guessing in healthcare, that's like, working in a hospital in a menial task, not as the top orthopedic surgeon, right? Or
Sure.
working in an old folks' home to help take care of the growing sort of gray part of this
Our population is getting older.
Exactly.
Yeah.
But the professional services, business and professional services, what is that? Is that back office work? Is that like secretarial work? Or is it like, AI teaching?
It includes legal professions, it includes accounting services, it includes administrative services, it includes management services. So part of it is that these are folks that you should see getting hired during a cyclical upswing, but these are also the people who are most exposed to AI replacing them in the workforce. Instead, we're seeing a reassessment of just how much of their work AI can do. These were also the folks who were on the chopping block. These were the folks who were subject to high-profile layoff announcements from some of the largest companies. Again, instead, in the April data, what we're seeing is some reassessment of just how much crowding out of that work can be done by AI. So I think that it's interesting to get this report. But to your point, this is about job vacancies. It's about the relationship between workers and the technology that's available to them. And it's the relationship between workers and the economy that they're interacting with. This is not specifically hires. We get hires for the month of May on Friday, and we're expecting to see about 95,000 jobs added during the month of May, steady unemployment rate of 4.3%. But again, when all of the hiring, when all the vacancies are concentrated in just a few industries, it does not spark a ton of optimism about labor income growth and spending growth.
At least there's a silver lining of AI not taking jobs in professional services.
That's right, I'm safe for now. I'm safe for now.
We're all safe for now. Stuart, thank you very much for joining us. Stuart Paul of Bloomberg Economics. Let's bring in now Kara Murphy, Chief Investment Officer at Kestra Investment Management. Kara, great to see you this morning. And Stuart makes a really interesting point. Parts of this economy that you think would be highly impacted by AI are not yet. What is your thinking on how this economy evolves, especially when it comes to jobs? If there will be a point that you start to see meaningful declines in job openings and hirings because of technological advancement?
It's interesting because this very threat from AI tends to be the most common question I get when I speak with end clients who are worried about their kids going into the workforce. Are their jobs going to be gobbled up by AI? And of course, there are plenty of people in the labor force today who worry about that. What we've seen from other technological revolutions is that over time, a new technology creates enough demand to create jobs in other places, right? So over time, what you have is a growing of jobs rather than a decline. The concern about AI in particular is that this technology is sort of taking hold and increasing so rapidly that the worry is that it happens so fast that the demand can't kind of take over. But as you saw from the numbers this morning, we haven't seen it in the numbers. There are a few areas like computer scientists where we're seeing it very clearly hit by AI, but more generally, we're not seeing it. And I think in general, what you'll find is that the labor market in time should adapt. Jobs will move, but over time they'll grow. I want to point out, though, there's another piece of this story, which you guys touched on, which is the wages, right? So we're seeing some increase in wages, but inflation is also increasing. What's really important here is that those numbers don't impact the population uniformly, right? You have the lower end worker who's much more impacted by these inflationary pressures and is seeing less wage increase. And those individuals are less likely to own stocks, which are creating wealth opportunities for higher income workers. So I think this dynamic is really exacerbating what is often called as the K-shaped economy.
At the same time, Kara, we saw Dollar General raising its outlook. Victoria's Secret, really strong sales, profitability, profits were double what were expected. That's not exactly higher income shoppers at these types of places. That doesn't seem to suggest any sort of major deterioration.
I think you're right. I mean, this is not a matter of falling off the cliff. You'd have to see a lot of job destruction for that. But I think Dollar General is a good example of where you're seeing, potentially mid-tier consumers who are trading down to make up for the fact that, their gas suddenly costs more, the utility bill is more. They have to find room in their budget somewhere, and Dollar General helps to fill that gap.
So how do you invest, Kara, in an economy where there's so much capital spending to build out AI? I mean, hundreds of billions, trillions of dollars in capital spending that's going to drive a number of industries higher, but the consumer, the bottom, let's say 50% at least, is struggling to pay for gas and food.
It is a tension that needs to resolve itself at some point. So when you think about 3.5 years now, the market has really been driven by this AI story and a handful of names. You have technology and communication services that now make up almost half of the S&P 500. Now, if you look at other technological revolutions, you introduce a new technology. The initial winners are the creator of that technology, but eventually everybody in society and the economy benefits from that, right? Railroads were really great investments for a time, but then it was everybody who used the railroads who benefited. Over time, we'll see this with AI as well, which means that that benefit begins to permeate out from this like very small group of a handful of winners to those companies that use AI and become more productive as a result.
On the AI trade, one of the trends that we've seen is one of the pillars of this equity market, aka buybacks, have started to really diminish when you have these hyperscalers not only seeing cuts to their free cash flow, but cuts to their buybacks as a result. Save for NVIDIA. I was having this conversation with Michael Ball, one of our Bloomberg macro strategists on the MLive blog, and I made the point NVIDIA is spending something like 50% of its free cash flow back to buyers, but he made the point, okay, but how fragile is that with the circular financing of everything? What does it do to the market to have these big stalwarts, the big tech names that once issued a lot of buybacks, now to be pulling back?
I think what you're seeing is under the hood, a subtle, not so subtle shift in the business models of these companies who are investing heavily in AI. As you point out, it's not just NVIDIA, but all of these companies that are at the forefront of building these models are expending enormous amounts of their free cash flow, and now they're taking on debt, right? So the balance sheets look very, very different than they did just a couple of years ago. So the question is, can the revenues accelerate to an extent where eventually then you start to be able to pay down that debt and these become free cash flow machines? So again, it's all about timing and how rapidly can that demand and those revenues make up for this additional cash need. And I think it's a bit of a race right now, and we won't know for a couple of years who's going to come out on top.
Kara, great to have some time with you. Thanks so much for joining us. Kara Murphy there of Kestra Investment Management. Let's get a check on what's going on in the markets. Just about 40 minutes into the trade here. You see the S&P pretty much flat at 75.96, 75.97. The NASDAQ actually gaining about 40 points to 30,555 as the 10-year yield, as yields across the curve come a little bit lower. Now we're at 445 on the 10-year right now. We have been much lower earlier in the session, so those are coming back. And Brent crude, which also was much lower during the session, continues to fall, but now only a nickel to 94.93.
Let's also take a look at some of the single stocks moving this hour. As we've been mentioning, Google announced plans to raise $80 billion in equity to help fund its AI spending. It's dilutive. It sends shares lower by only 2.25%.
Marvell surging after NVIDIA CEO Jensen Huang called it the next trillion-dollar company. If he mentions you or your industry, you can wait. Was it just down?
No. That was Alphabet. We don't have Marvell for whatever reason.
Okay.
I am very sure that
I was confused by the red arrow.
Yeah, no, it's still up. Yeah, I think you're about to say you mentioned that. You mentioned software. Jensen Huang,
as long as he says it, it does it, right?
Pretty cool.
The godfather of AI.
I hope he doesn't have any secretaries who are on betting markets because
they know.
It could be bad. They know. They know. Who sees his speech?
You know, little payout.
No, come on. That is. I am pretty sure that is not legal.
Is that not? I guess it depends on what market you're doing it in. In any case, coming up, we'll talk about private credit markets. U.S. private credit firm Castlelake reportedly seeking out a partner for its potential EasyJet takeover bid. We'll discuss the implications of a buyout next. This is Bloomberg Open Interest. Let's get out of high interest. Look what's making headlines around the world. The Trump administration is backing away from a controversial $1.8 billion fund for alleged victims of government weaponization after criticism from both sides of the aisle. Republican senators say private assurances aren't enough, though, and they want a full public commitment to kill the fund. Questions, though, still remain about whether scrapping the fund would also affect a separate settlement provision that reportedly barred the IRS from pursuing future probes into Trump's tax returns, the tax returns of his businesses, and the tax returns of his family as well. President Trump has named Federal Housing Finance Agency Director Bill Pulte as acting director of national intelligence. Pulte, who has no military or intelligence experience, will keep his housing roles while temporarily leading the intelligence office. The move comes after Tulsi Gabbard announced she will step down from the post later this month. And the Financial Times is reporting that the U.S. private credit firm Castlelake is exploring a takeover bid for EasyJet and seeking an EU partner to satisfy airline ownership rules. The takeover interest has reignited debate over whether UK-listed companies are undervalued. Meanwhile, EasyJet has called Castlelake's approach highly opportunistic, which is a good thing, I would think, if you're in this market to make money. Don't you seek out opportunities? Isn't that the point?
If you're the buyer, but if you're the one being sold, you're just taking advantage of this.
I just feel like opportunistic, that's part of your fiduciary duty, right?
Well, no. They're saying that they're jumping in an opportunity that maybe. Let me not explain it. Let's get to the expert in this Castlelake potential bid for EasyJet with Bloomberg senior reporter Silas Brown. I mean, Silas, one of my big questions is, isn't this a credit fund? What are they doing trying to make a leveraged buyout of EasyJet?
Yeah, I would say that when I read the highly opportunistic thing, I was on the Matt School of Philosophy, which was surely every takeover is opportunistic. But anyway, look, they specialize in private credit, but they also specialize in kind of all manner of complicated aviation investing. And so I think they are, to a certain extent, an outlier normally in terms of takeovers, but I think they sit in the sweet spot of aviation specialism and then also the UK market, which is kind of considered undervalued versus its peers.
Hey, I want to ask a question that I've been asking across asset classes, Silas. It seems that there's a flood of cash going everywhere, certainly into hedge funds, right? The big multi-strat firms have more capital than they have ability to deploy it. In fixed income, we see corporate spreads at record tights. I mean, at least over the last 20 years. And in equities, obviously, just cash pouring into this market, driving us up to all-time high after all-time high. Do you continue to see that kind of cash flow into private credit as well, even after the sort of cockroaches scare of last year?
Yeah, I think you're right. I mean, one of the things that I found most eerie over the past 3 months is, I mean, look what's going on geopolitically, and all of these things should have the inflationary pressures that are becoming more and more visceral. All of these things should have consequences on margins, and yet there's a kind of eerie tightness going on in private credit still. And I think that is best explained by just the sheer amount of cash that is able to be deployed. I mean, there's a lot of dry powder still sitting in private credit funds, and so you haven't really seen much of an impact on price. And I think that that's quite similar to a kind of variety of fixed income products that we track.
Silas, great to get some time with you. Thanks so much for joining us. Bloomberg's Silas Brown reports on private credit out of London. By the way, right now, Bloomberg News editorial lead for EMEA, Jackie Simmons, is speaking with Norwegian finance minister and former NATO Secretary General Jens Stoltenberg in Oslo in an exclusive Bloomberg Newsmakers conversation. Let's listen in.
Investments in companies tied to human rights abuses. So internationally, every exclusion, if it's Caterpillar, if it's Israeli holdings, that can be read as a political move. So I wonder, how do you manage, that with what apparently Norwegians say, who are the shareholders, say they want?
My answer is that we will continue, and we continue to have an ethical framework for the sovereign wealth fund. We made some changes last fall. We will establish a revised and updated ethical framework next year, because we now have a commission which is now looking into it, and they will propose an updated framework, and we will have. They will present their report this fall. It will be a public hearing, and then we will present the white paper to the parliament and then make decisions. But in the meantime, it doesn't mean that we don't have an ethical framework. The pension fund still conducts what we call responsible management of the investments, meaning they're following guidelines from the UN, from the OECD. They have expectation papers for the different companies they're invested in. They have dialogue with the management and the vote on the also general assemblies, and they also sometimes can withdraw from divest from the companies. The only thing we have suspended is this system of independent ethical council that give advice to the National Bank or the Norwegian Bank, and then that the Norwegian Bank then withdraws from those companies. And the reason why I suspended
that is the Norwegian finance minister and former NATO Secretary General Jens Stoltenberg speaking with Jackie Simmons in Oslo. You can continue to watch that conversation live. Go on your terminal. This is Bloomberg.
You're talking about big tech, or?
No, I'm talking about different things. Also, I'm talking part about big tech, meaning that
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing essentially an hour into the session. The S&P 500 pretty much unchanged at 75.97 right now. The NASDAQ as well. Not a lot of movement here, but at a record high, 30,514. You take a look at, well, the dollar is also little changed. Brent crude is also little changed, now rising a little bit. Yields are also very little change right now. So we're looking at a pretty flat market. Nvidia is up, however, more than 2%. And Marvell Technologies, called out by Jensen Huang, CEO of Nvidia, now up 23%. Google is off, but only 1.5% after saying it's going to raise $80 billion. Hewlett Packard Enterprises jumping 25%. CEO of that company up next with Ed Ludlow in the 11 o'clock hour. You see Dollar General coming down after earnings this morning, 3.25% the drop there. And Victoria's Secret, the ticker VSXY, up 46% in one session after having already risen 160% over the past 12 months. Absolutely crushing it. Coming up, MongoDB posts strong quarterly results, higher guidance. We speak with the CEO, CJ Desai, next.
MongoDB shares pulling back today after a rally on strong earnings. The software company beat expectations, raised guidance, and highlighted accelerating interest in its AI products. Joining us now is MongoDB CEO CJ Desai. And CJ, I know you've had to deal with a lot of the fears over software and its impact from AI. At one point, I think you were down something like 46% from the highs in January. You're still down about 10% from those early January levels. But I would note Morgan Stanley raised their price target on MongoDB, saying that you're about to see a tailwind from AI. For those who aren't familiar, how does a database company profit from AI?
So, Dani, it's pretty simple. First, and the foremost, we had a very strong print after Thursday. On Friday and Monday combined, we are up 24%. And over the last 3 trading days before today, we are up 37%. So very, very good reaction by our investors. And coming back to your question, Dani, it's very simple. No matter what kind of agentic workload you run or AI workload you run, you always need LLMs, you need harness, and you need a data layer. And we provide that strong, robust data layer that can scale as agentic workloads scale. So we are seeing early momentum where AI companies, including frontier labs, are building on MongoDB as the data layer. And we are seeing that early traction in the enterprise as well. So I'm very encouraged by what I'm seeing play out across the globe.
I mean, I just wonder why it takes Jensen Huang mentioning this, CJ, to really get investors focused on the fact that in order to use these apps, which we now all use on a daily basis, you need to have operational data, vector search data, persistent memory embeddings, re-ranking, like all of this stuff, which we're currently using a lot of times many different tools for. And you provide all of that as one back-end layer. why are you only a $30 billion company? Why hasn't the market bid you up to 60 or 90 or more?
That's a great question. And what you outline is 100% true, that we provide the data layer with search, vector search embeddings all in one with real-time data and operational data, so you can truly run agentic workload. From what we are seeing right now, we had a slight acceleration in Q1 compared to Q4. Our Atlas business that investors really care about grew 29.4%, and we raised the guidance significantly for the year, including the profitability. And what I would say, Matt, is that it's not if, but when. And as enterprises start building these agentic applications, most of them are in early journey compared to like Frontier Labs, who build on MongoDB, or AI native companies like 11 Labs, Mercor, others, they completely build on MongoDB. 11 Labs has 40 million agents running on MongoDB. So I would say the enterprise is on a little bit behind trajectory. And at 2.5 billion plus, we are very optimistic, and I feel very good about the business.
Hey, we're looking at just a wall full of your logos, customers of yours. How many more logos are you adding to these walls, CJ? I mean, how many more clients are you going to be adding, you think, in the next 6 to 12 months?
I would say, when I look back at Q1 or consistently over last 5 to 6 quarters, we add somewhere between 2,000 to 3,000 customers or new logos. So in Q1, Matt, we added 2,500 new logos, and I feel very good about it. They come through our self-serve motion and sometimes directly via enterprise. So 2,500 is a quarterly rate, and as more and more customers are aware of our capabilities that you outlined beautifully, I would say we will continue to add. So I would be disappointed if we don't add 5,000 to 10,000 additional new logos in next 6 to 12 months, whether it's startup ecosystem, digital natives or AI natives, or enterprises that continue to expand with MongoDB.
CJ, at the same time, you've come into this company more recently, and since then, as leaders tend to do, doing some shakeups of the C-suite, a new chief product officer for AI, a new CRO from Confluent. Do you have any more changes you think you'd like to make to the company?
I would say that first, I feel very good about the team in place. They all joined recently. One chief product officer who we promoted internally has been with us, Ben Cephalo, for last 9 years, and he will run core products, Atlas and our Enterprise Advanced. And Pablo Stern, based in San Francisco, would be running everything AI. AI is currently the center of gravity is San Francisco, so I feel very good about him leading AI and emerging products and working in the AI ecosystem. And for Chief Revenue Officer, yes, RaeAnn McBain joined us end of April on the tail end of Q1, and really fired about him and Erica running the go-to-market. So the team is in place. We have a great CFO, and I feel very good overall about the team that will help MongoDB scale.
It seems like Jensen Huang, though, is your best. Like, he should run your IR division. How important is it that the godfather of AI, as Dan Ives calls him, calls out MongoDB, calls out software makers? Because it feels like he does more for you than your earnings.
I would say that is true. Love Jensen, probably the best innovator I have met in life, and really enjoy our partnership with him, even when I worked with him in my previous jobs. And here is what I would say. There was this whole fear about SaaS, software, what is the role of software, will it get disrupted? And it's just not true, right? I look at enterprises, they are actually creating, because of AI, as Jensen calls out, even more apps. And what we are lacking right now for software industry is optimism. What we are lacking is imagination. And you combine the two, imagination and optimism, I believe we will create fantastic AI applications for years to come. Most of the AI transition, like cloud transition, Matt, takes 10 to 15 years. And I would argue that we are still in early innings.
CJ, go ahead, Matt.
Well, I was going to say, great to have you. I know you worked previously you mentioned you're former experience, right? At Oracle, at Pivotal, at Norton, LifeLock, at Symantec, at EMC, and now obviously running MongoDB. Great to have you on the program. Hope we can get you back. CJ Desai there, the CEO of MongoDB.
Now, as for your markets, we have turned positive ever so slightly so, and this would mean we'd be gaining for 6 days running, rather 9 days running. It would be a 6th record high. If we are able to put in another day of gains, it would be the longest winning streak since May of 2025. Helping us, yields are coming in, a strong jobs market. There are jobs opening. This economy is clearly doing well. And Brent crude moving lower by 0.2%. All of that shaping up to be supportive of this equity market.
Let's get a look at some single stocks moving at this hour. Dollar General is one we've been talking about, nudging up its profit outlook. But the CEO says shoppers are cutting back on food and other household expenses due to rising gas prices. And just yesterday on this program, Meredith Whitney pointed out that Dollar General is more reliant on grocery than Dollar Tree, so that hurts.
Interesting. It was just up before the CEO made those comments, or the executives did. Elsewhere in consumer, Victoria's Secret delivering better than expected earnings, signaling progress for the CEO's turnaround plan and punishing all of the many short sellers. Victoria's Secret up 40% today.
Goldman Sachs downgrades Intuit to a sell, citing pressured fundamentals. It's the only sell rating on the Bloomberg screen for that stock, and it still has the power to decimate the company's market cap. Intuit down 10%.
Coming up on the show, the collector car market continues to gain momentum. We ask Hagerty CEO McKeel Hagerty on what's driving demand. That's coming up next. This is Bloomberg Open Interest.
The collector car market is heating up, with auction sales topping $1.15 billion so far this year. From vintage Ferraris to iconic muscle cars, collectors are paying record prices. Joining us to talk about that is Hagerty Chairman and CEO McKeel Hagerty. And your business has grown to be such a behemoth in this industry, McKeel. I mean, just give us the origin story, because you started out insuring classic cars, right? And then you did a takeover of the auction business. Now you're doing a takeover of the media business as well. So tell us about Hagerty.
Well, I mean, it's all based on this idea that, there's this, huge audience of drivers who love drivable cars that are fun to drive. And we started in the insurance space, which is it's a wonderful industry. It's recurring revenue, kind of snowballs on top of itself. Passion builds on top of passion. The media and events piece was a big part of the story, because what we needed to do is, how do you get the word out? How do you get the word out about the love of the automobile? How do you bring people to the front door? And so investing in those things, building those assets were a really important part of our thing. We have a membership organization. It's the largest membership group in the automotive space, called the Hagerty Drivers Club. And then the auction world, and that's both live auctions and digital auctions, our marketplace on the digital side, and then Broad Arrow auctions, which are kind of setting record after record right now. And it's all a big flywheel. It all kind of works together. If you come to insure with us, we engage with you as a member and in media, and then hopefully when you go to buy and sell a car, we're the ones that you come to. And so it's been fun. Like, I have a really fun job in the car world. Yes,
yes, you do. I mean, I spend a lot of time watching Jason Camissa's videos for you. Yeah. I just talked to Ken On, who runs your Broad Arrow auction business, on my podcast, Hot Pursuit. And I love the events that you run. I was just telling your colleague Kevin Fisher here about the time that we went and toured this house of a guy who had a sweet Mercedes Gullwing and an old Ferrari and some Stephen Harris designed with his old Porsches. And it's just a really cool business. How much does the other stuff feed into your insurance business? Like, how many clients do you get from the auction, from the media, from these other parts?
Yeah, it's all, again, a big part of the flywheel. I mean, the biggest front door is the garage door for us, and that is insurance. So we have all these partnerships bringing both consumers directly and also, through big insurance partnerships. And that's great. But again, insurance is not necessarily the most emotionally engaging product or service. And that's why the membership thing works. A lot of people come to us because they're reading our articles. They're watching those Jason Camisa videos, or Barn Find Hunter, or one of our other video properties. I mean, our YouTube channel, we have 4 million subscribers, and it's all automotive content. We have a Samsung streaming fast channel. We're on Prime Video. doing real automotive content, and they help kind of feed the whole thing.
I'd imagine it wouldn't be a stretch to assume that your audience, your buyers, the ecosystem heavily skews male. And with that, it's maybe not a surprise because so much wealth is in men's hands. That's going to change. There's a silver tsunami, and the expectation is that by far a majority of the wealth will sit in women's hands by the end of this decade or early next decade. How does that change your business?
Well, it doesn't. I mean, we love that. Whoever the owner is, whatever generation, whoever they are, we love it. And our job is to serve up the kind of things that will make that attractive, make it easy to understand, and kind of remove the barriers so that drivers can be drivers. And this huge wealth transfer that we're already seeing, our estimates based on just our book of business and as we see it, is about 30% of all of these cars will trade hands or come to market by 2040. So almost exactly to your point. It's about $570 billion worth of cars between now and then. Many of them will go from, maybe a male principal owner or a first-time collector, go to, a spouse, go to their kids. And our job is to engage them across ages. And whether it's, engaging them through a video game, whether it's engaging them through high-quality content, whether it's events, like a lot of our events, we really position them to be great couples events. So we try to engage people across, family and generational lines. And I think it's critical as we get ourselves ready for that future.
By the way, I met your wife before I met you because she was working at Lamborghini. Soon Hagerty used to run their PR. Let me ask about the auction business and the growth that we've seen this year, because the numbers have been astounding in terms of especially cars from just the 90s or the early 2000s that are selling for double-digit millions. How much growth has that seen, and how much is that fed by the success of this stock market?
Yeah, well, of course, I always go back to the root cause, which is where's the money come from, who's buying it, buying these things, and it's often stock market wealth, it was crypto. There's lots of different pieces when people feel like they have extra resources and they want to go buy really fun stuff in their lives, not just another home. A car is often one of the first things that they do decide to buy. And you're right, like we're up 36% in that high end of the auction transaction world this year. A lot of it driven by Ferraris, a lot of it from the late 80s, 90s, and even early 2000s. And in fact, there's some cars that are even just a few years old that are selling for multiples of what they sold for right off of the dealership floor.
But those are internal combustion engines, right? They're not electric Ferraris yet.
Not yet, not yet.
Could you see that? Could you see an EV become a collectible?
Absolutely, and we see them already. I mean, there's some great EVs out there. If they're high performance and they look good, that tends to drive collectability. I'm very agnostic about what drives cars. I always remind people in the history of cars, there used to be steam-powered cars. There were electric cars 120 years ago. There are electric cars now, and I think there'll be a lot more of them in the future. But I also like the fact that these more aspirational car companies like Porsche, like Ferrari, like others, remain committed to building great drivers' cars, and if people want to buy internal combustion, it's great. I always remind people, these cars are not driven much. Many of the cars that we insure, they're driven sometimes 1,000, 1,500 miles a year. So, these are limited use. It's a special car for that weekend drive or if you want to go show off to your friends. And that's kind of where we sit. And in great times, you see these rise in things like all these Ferraris and other things selling at the top end. And when things get kind of wobbly, and there are headwinds, let's face it, in the economy, people tend to hang on to what they have. And so it's a very durable market. It's a very durable business for us. And that's why I always tell people, like, building a cool lifestyle business on top of an insurance business has been an awesome way to do it.
You don't have any friends, clients who bought a Luce yet. Do you expect that someone would be able to insure a Luce through you?
For sure, for sure. I mean, Ferrari, there is no brand at the top end of the car market that, both vintage-wise or even almost brand new cars, that has driven more demand, more interest. Think of their public offering and their stock price since then and their, F1 racing and all of it. And I also remind people, like, Ferrari has designed a lot of different kinds of cars through the generations. They've built cars that look slightly more like a sedan. They have the Purosangue, an SUV. And I get it, like, not everybody's loving the design of this new car, but they're testing some things. They're trying a new market, and I will just wait and see.
Yeah. No, I think that's fair.
I'm still thinking about, like, the next romantic date that me and the hubby are going to go on is, like, something Hagerty involved. I'm still thinking about, like, the couples events.
Yeah.
That being the romantic night out.
Maybe you go to an auction.
Yeah.
Come to an auction, go for a drive. We have all these driving events, and it's all meant to be fun, and it's meant to engage people, and it's not just kind of gearheads being gearheads, and that's what makes it awesome.
Yeah, it is. It's a family, can be a family outing. I took my wife and my daughter to a Hagerty thing. All right, McKeel, thanks so much for joining us. I know you're going to go on Masters in Business next with Barry Ritholtz. Hope I'm not spoiling anything, but I know people love that podcast.
We're going to have fun.
So I'm looking forward to hearing that episode. McKeel Hagerty is the CEO and chairman of Hagerty. Also, he's been on my podcast, Hot Pursuit with Hannah Elliott. Definitely check that out. You can hear it wherever you get your podcast. Just search Bloomberg Hot Pursuit. Coming up, Andrew Left's guilty verdict could reshape the short-selling playbook. He's going to appeal. That's next. This is Bloomberg Open Interest.
Short seller Andrew Left faces the possibility of decades in jail after being found guilty of using disingenuous social media posts to manipulate stocks. Left denies wrongdoing, plans to appeal, and faces sentencing on August 31st. For more on this landmark case, we're joined by Bloomberg legal managing editor Ben Bain in Washington. Ben, I want to get to the implications, but first, can you just go over the details of this case? What exactly Left did that landed him in this trouble?
Sure. So basically, the government's accusations were that Andrew Left, at its very heart, Andrew Left, one of the most famed short sellers out there, is essentially making social media posts that don't align with his personal trading activity. So there's essentially a mismatch here in terms of what he's saying. And as you know, short sellers go out there, they express a view, oftentimes a bearish view on a company. And they go ahead and have a position in place. And once the market becomes aware of what they're saying, they would profit from that bearish position. What the government alleged here is that what Andrew Left was saying publicly in social media posts didn't align with what he was doing in terms of trading activity. So there's certainly a big implication, a broader implication for the short selling industry. This is an industry that's oftentimes draws the ire of corporate executives. It's, if you think back to the meme stock craze in particular, during the pandemic, there was certainly increased scrutiny on short selling. It kind of comes and goes in cycles. Short sellers fall out of favor. And then, they basically come back. But this case in particular, did expose something that Andrew Left was accused of doing, which differs from general short selling activity.
I mean, it sounds like they're essentially accusing him, and it's not just an accusation at this point. They have proven he was doing a pump and dump, although it's the opposite of a pump and dump. So he was, getting out of his short positions after he trashed the company. What are his chances on appeal? Because he has implied that he will be doing that.
Yeah, that's right. I mean, it's strongly implied that an appeal will be forthcoming. One interesting thing that happened yesterday is his lawyers are also moving for a mistrial. So in addition to appealing this, there was a situation with the form the jury got where one of the charges that was dropped prior to the trial was included on the verdict form that the jury got. So his lawyers are also actually going to seek a mistrial as well. Now, in terms of the appeal, what Left said, has said all along and during trial is that he believed everything he was saying. And there's not really a time bar in terms of when you can trade and relative to what you're saying publicly. So I think whatever we see on appeal, we're probably going to dig further into what the guardrails are around short selling activity. He's always made this also a free speech kind of case. He's tried to, at least. So I think we expect to see more of that as well as he tries to take this on appeal.
Ben, thanks very much. Ben Bain covers regulatory issues for us out of Washington. Coming up tomorrow, Citizens CEO Bruce Fanson, Victoria Fernandez of Crossmark, and Ellen Zentner of Morgan Stanley. This is Bloomberg Open Interest.